Good afternoon and welcome to today's webinar on regular mistakes made by firms identified when we complete their audit with Paula Wheatley from Charnwood Accountants. For those of you who haven't joined our webinars before, my name is Lucy and I'm an assistant consultant with DG Legal. The slides from today's presentation will be sent over tomorrow and a recording of the webinar will be available to you. So if we do run over and you do need to leave, you will be able to watch the rest another time. We are in webinar mode, so we can't see or hear any of you. So please use the Q&A function at the bottom of your screen so that Paula can answer your questions. So by way of a brief introduction to Paula, she has been with Charnwood Accountants since 2011 and heads up the solicitors division of the firm. Paula is a true specialist in advising legal practices on their financial planning, tax efficiency and compliance with the SRA audit regulations. With her expertise in the sector, combined with working in general practice, Paula has delivered some exceptional results for the legal practices she works with. Over to you, Paula.
Thank you for the introduction. So I will just start by giving you a bit more information about us. So thank you all for joining me today for this webinar, which is on regular mistakes made by firms which we identify when we're doing our audit work. So just to give you a bit of background about us as a firm, we have a large number of solicitor clients which cover a vast range of legal sectors. This means that we've developed a really good understanding of the industry and the factors that affect solicitors' practices. I am one of the partners and head up the solicitors department, and over the years my role has developed from the standard services of completing the audit and preparing the accounts to assisting the cashiers and practice managers with internal compliance, and now my role involves spending time with the partners of the firms discussing the development of their business and succession planning. I've therefore witnessed each area of practice in action and feel I'm really able to add value to the clients that I act for across the whole firm. Today's webinar will explain to you some of the regular mistakes that we identify when we're doing our client account audits and how we can help you rectify them. I'll leave time for questions at the end, but I will try and answer them as I'm going along as well, because I'm going to do some demonstrations, so it'd be nice for you to be able to get them answered there and then. So one of the key areas in terms of your client account is bank reconciliations, and this is where we find a lot of common mistakes. We see a range of mistakes in this area, and when we take on new clients, we often find that they don't even complete a formal reconciliation statement. So we do a lot of work with those clients, getting them up to scratch. But for our existing clients who do generally do our bank reconciliations well, there are still mistakes that come through on occasion, which we sort out with them as we're going along. But the rules do state that you need to obtain bank statements and reconcile them to the cash book and the matter balances report every 5 weeks, and they must be signed and promptly resolve differences when you find them. And I've noted the rule information there for you. But just to expand on that in a bit more detail, I wanted to talk through each element of them in more comprehensive fashion. So firstly, it says you must do a formal reconciliation statement. This is a front page document that ties together all of the reports that you use for your reconciliation so that it's all in one place. It must be three-way. This is the bit that is quite commonly done wrong. And three-way, what that means is it needs to agree from the bank statement to the cash book report to the matter balances report. A lot of solicitor softwares have these reports. Most of them do. It's rare that they don't, but some of them might call them slightly different things. So you might see a variation on those three names that I've just said there. Next, the reconciliation must be prepared 5 weekly. So many firms will do the client account reconciliation actually on a daily basis. So they'll do all of the postings of the transactions every day. And they'll probably tick off the bank statements every day to prove that it all works. But the formal reconciliation statement, they tend to probably do on the month end date. This is absolutely fine, because obviously you're thinking you're doing it monthly. But the important thing you need to consider is when you do the reconciliation. So when I review our clients' audits, I'm looking for the date that those reports were printed. And ideally, you want to see that they've been done roughly within a week of the month end date. And then you know you're in your 5 weekly process of completing them. Also, the reconciliation shouldn't just be for the client account, it should be for any related client accounts. So if you've got designated deposit accounts for clients, these should be on your reconciliation, and any undesignated deposit accounts as well. Everything should be included if it's a client account. It must also be signed by a COFA or a manager, and we also recommend that it's dated as well. There's very little value added by the COFA or manager signing these off when it's done 3 months later. So again, I would expect this to be done within roughly 1 week of the month-end date. And the other thing that we do quite often find is you need to actually review them. There's no point in taking it from the cashier or whoever prepared it and just signing it. You need to look at the documents that make it up and make sure everything agrees. Because at the end of the day, everybody makes mistakes. And if you just sign it without looking, you can't help rectify those mistakes. And so you're not doing your role as COFA correctly. Next is differences. Now, it's really important to note that differences are okay as long as you make a note of them on the face of the reconciliation statement. As I said, nobody's perfect, and there will be occasions where mistakes are made and then you identify them when you're doing your month-end reports. But as long as you note the differences on the face of the statement and note what actions have been taken to correct them, then this isn't actually a breach of the rules because you've made aware that there was an issue. Generally speaking, a lot of the things that go wrong on the bank reconciliations, we don't always report on the AR1 or the audit report, which we prepare for you at the year end, because they tend to be more administrative errors. And so if we can demonstrate that it was just a rare occurrence, there's no point in reporting it to the SRA, there's been no loss to the client. But in terms of reconciliations, if you persistently have reconciliations that aren't completed correctly, or they're done late, or they're full of errors, or they're never signed, or you don't actually do that formal one-sheet document, then these are things that we would have to report on the AR1 to the SRA. Next, we have debit balances. So debit balances on the client account are an absolute no-no. This suggests that it's overdrawn. Now, these shouldn't ever happen because most software for solicitors will give a warning before a payment is allowed to be posted onto a ledger to say that it will be going overdrawn. And as long as you don't ignore these warnings, in theory, you never have the problem. And also, in saying that, it's a really good reason why you should keep your ledgers as up to date as possible, as often as you can, because then you know that the client account balance you're looking at on that ledger is the most up-to-date figure. However, if you do have a debit balance on the client account, which, as I said, sometimes these things happen, then you need to pick this up as part of the month-end reconciliation process, and you need to explain it and correct it. So a lot of our bank reconciliations, if we do have a debit balance, it's like it's almost ignored in that reconciliation process because overall, all of the reports agree still, and that's not how it should be done. And also, while you're looking at debit balances on the client account, it's just worth noting that it's also an ideal time to look at any on the office account, which might suggest that it's client money being held in the incorrect place. So if you do spot any at the same time, you may as well correct them just so you know you've done your job well. Okay, so now I'm going to do a practical example. So please just bear with me while I switch screens and hope that the IT doesn't fail me. So bear with me. Okay, so I believe now you should be able to see an Excel sheet on your screen. If you don't, I'm sure somebody will shout up in a second and let me know. But this is an example of a really good client account reconciliation statement. And what I'm going to do is just talk you through how I would fill it in. So here on PDF, I've got some examples of the bank statements, a cash book, the designated deposit account cash book, and the matter balances report. And I'm going to just fill it in to show you what I would do. So in this case, my month end date is the 31st of October. Oops. October 2020. So first thing is to reconcile the bank statements to the cash book. So the first thing to do is look on your bank statements. I've collated mine all on one page for you here. So you can see I've got the main client account, which shows this bank balance, and I've got my 3 designated deposit accounts, which are these 3 here. You'll also note on it that the last designated deposit account statement was issued on the 30th of September. That's okay, because even though we're doing the October rec, you should use the most up-to-date bank statement that you have. So I'm just going to go and put my bank statement figure in here. So the client account was 4,335,470.47. And that statement was issued on the 30th of October. So that was the last transaction for that month, for that particular one. I then need to put in my unpresented items. So, you know, your unreconciled items on your cash book. So this here is what this particular cash book looks like. A lot of them will have some sort of summary like this, where it will say statement balance, what your reconciled items are and what your unreconciled items are. Now, on the actual statements that I've prepared, we separate out the payments and the receipts into 2 sections, but you can amalgamate the 2. It's completely your choice. So I've got checks outstanding of £375. So I'm going to type that figure in here. And as I said, I don't have any uncleared receipts. Then I am going to go back to my bank statements and get my designated deposit accounts. As I said, that was these 3 here, and 2 of them were issued on the 30th of September. 1 I printed off for an online statement today, effectively. So we'll put those figures in, which is 595.52 on the 30th of the 9th, 20. 6011.82 on the 30th of the 9th, 20, and the last one was 698,387.26, which was on the 31st of the 10th, 20. Okay, so that is to reconcile my bank statement and unreconciled items. The next section of the reconciliation is to make sure that that agrees to the cash book reports. So obviously I've already shown you the cash book report for one of them. So the figure I'm picking up here is my cash book reconciled amount of this one. So let me put that in here, cash book 4335, oops, 5095.47. And then we want the deposit accounts cash book. So your designated deposit account should also have a cash book. Now, one thing you might notice here is that I've actually used a trial balance rather than a formal cash book. And that is because, as I mentioned earlier, the designated deposit accounts last had a statement issued on the 30th of September. And actually it's had no transactions during October. And some of the solicitor's softwares therefore don't let you run a cash book report. And so a common thing that we find is that then nothing is put on file to show how that balance proves. But what I like to see instead is that you generate the trial balance, because the trial balance for the firm can be run every single month at any point and shows effectively what your cash book figures are. So this is a good alternative for when you don't have a cash book for your designated deposit accounts. So let's pop those figures in. I've done mine as a total here, so add them together. 226. And as you can see, my bank statement and unpresented items equals perfectly my cash book, and so therefore I have no differences. So the final section as part of your 3-way element is to then make sure that this cash book agrees to the matter balances reports. So I've already brought down the figure because I know what my cash book figure was supposed to be. So I'm now going to agree that to my matter balances report, which is just here. And this particular version shows your client account just here and your deposit account just here. So I'm just going to pop those 2 figures in. And the other one was 834,994.60. And again, you can see that they perfectly agree, so I've got no differences. Now, you'll see here, we've got the debit balances on the matter listing. So as I mentioned, those are supposed to be shown on the face of the reconciliation statement wherever they happen. So what you would want to do is when you get this matter balances report, I've only shown you one page, but this one was actually a 76-page report. You just need to scroll through and make sure that there are no debit balances on your client account. Or equally, some of the softwares do run a report for overdrawn balances, so you could just run that report and put it on file. But say, for instance, I had £1,000 of debit balances, I would put that there and it would throw out a difference. And then I would need to give an explanation of that difference because, as I said, differences are okay as long as you explain them. So what I might write here is ledger XXX was overdrawn because funds were paid out of clients before check in had cleared, all rectified by 1st of the 11th 20. So therefore, in that explanation, I've said exactly what's happened, which ledger is affected and what date it was rectified, so that anybody who's reviewing it can see that you've carried out steps to make the correction. Same again for up here for when you did your reconciliation. Say, for instance, my checks was £475, you'd throw out £100 difference. It might be because you've misdated something in the system and the check cleared the day after and it sorted itself out. So you would just need to make a note of that accordingly. And then we come to the bottom. So what you would do is pass this to your COFA or your manager. So you provide them with this reconciliation statement and all of these reports that I've just shown you. So you'd give them the last page of the bank statement for the month, the cash book report, your designated, and your matter balances report. You would pass all of those over. They would be reviewed, all the numbers are cross-checked, and then they will be signed and dated so that you can prove that the work's been done. In terms of going paperless, a lot of firms will be saving these particular reports that I've just shown you as PDFs. What I would suggest is this is done with the paper copy and then scanned in, and you can then shred the original and just keep the scanned version within your month-end process folder. Okay, I'm just going to switch my screen back now and then just check to see if there's been any questions come through as a result of that demonstration. So if you do have any, let me know. Okay, so we've got screen share back, and I do have a question that's come through. Would you be able to provide us with a template of the bank reconciliations? Apologies. Yes, I've already provided the slides and the bank reconciliation template to DG Legal, and they'll send them around to everybody as soon as this presentation's done. So that's fine, thank you. And somebody else has agreed that they'd also be interested. So yeah, of course, they'll be sent over to you. And for now, that's it in terms of questions. So I'll carry on with the next section. So the next area is residual balances. Generally, these are the things that we put on the AR1 when we're creating our report at the end of the audit. Most of the time, as I said, the bank reconciliation stuff, it tends to be minor things, so we don't report them. But for most breaches, if we can demonstrate that they're administrative and no loss to the client, then, as I said, no report. But when you're holding client money when you shouldn't be, we have no choice but to report that, because effectively that's a loss to the client. So just to give you a few updates on some of the things that have happened since the rules have changed, writing to clients every 12 months now regarding the balance held has been removed. So that used to be rule 14.4, that no longer exists. So what that means is the SRA actually just want you to return the balances to the client as soon as the regulated services have stopped. They don't give any timeframes, but as a firm, you should have good file closure policies in place. And really, I'd be suggesting that balances should be completed and returned within roughly 1 month. I don't think you should be holding them for any longer than that, because there's no reason to be if the matter's concluded. You should also consider any uncleared items on your bank reconciliations at that point as well, because there's no point in writing a cheque to a client to get that money back to them if they then never bank it and it never clears your bank account. Effectively, you're still holding that money. So just make sure you do regular checks of your uncleared items on the client account to see if you could give somebody a call and say, did you get the cheque? Could I maybe cancel it and get some bank details from you instead, that kind of thing. And then the biggest area in terms of the SRA that they consider most serious is breaches regarding banking facility. The SRA do provide guidance and examples of what they consider banking facilities to be, because they consider it so serious. And to be fair, a lot of the instances that we come across with our own clients don't actually fit in with their examples, because their examples are quite detailed or really obvious that you've done something you really shouldn't do. Ours are more subtle for a lot of our clients, and it tends to be that they don't even realise that they're doing it. So the biggest instance is holding rent deposits at the end of the matter. When you've finished all the work for the tenancy agreements and stuff, you then keep hold of the rent deposit for the landlord and tenant. That's a breach. And also, if you retain money at the end of the matter because the client says to you, oh, well, actually, I know there's £100 left, but in 3 months I'm selling my house, so you might as well keep it and then we'll just use it for that. That's a banking facility and a residual balances breach. You are holding money that you don't need for no good reason because the regulated service is completed. So you need to return that money. We did attend a recent course where an SRA representative gave their opinion on residual balances and banking facilities. So I've just written pretty much exactly what they've said in quite a bit of detail, just so that you've got it written down and you can go back and read it if you want to. So what they said was there are prescribed circumstances where you can keep hold of money, but it's no longer part of the rules. So therefore, you can't just write every 12 months. If it's held and there's no work being done, it's a breach. And our role as an accountant is to now ask you for evidence of what regulated services are being provided to justify keeping that money. In terms of the historical old balances that you have on your ledgers, where we have examples where clients have merged with another firm and inherited a whole load of old balances and they just don't know what to do with them, and they've been trying to work on them, but they can't get rid of them all. The SRA said there's no fixed rule on this, but they just want to see some progress, and that they're happy if you use technology to find people. They were really up for you using social media to try and track people down, DWP, or those sorts of things. So they just want to see that you're making efforts to do it. So what we do with our clients is ask annually, what was the last thing you did? When did you last have a look at these? When did you last write to anybody about it? Those sorts of questions are what we'd be asking. But the SRA did say that the main concern for them is that if more new residual balances keep arising, because then that suggests that it's systematic, and so therefore we should be qualifying the report as accountants. And off the back of that, the SRA are now considering regulatory steps if repeatedly finding that we've put these breaches on the AR1, because it suggests that you're ignoring our advice and what we're telling you should be doing. And then they did mention a little bit on the deposits. So they said if you're holding deposits, if it's residential, you should be using the government deposit scheme. So there's no reason for you to be holding it anymore. For commercial agreements, they said that the solicitor isn't party to it. So why would they expose themselves by offering to hold that deposit? So it's a breach and it's reportable, and it should go on the AR1 without exceptions. Note, though, that if the solicitor is involved in a new build property development where the retention is for road adoption, for example, this wouldn't be a breach, because usually the schemes specifically state that the money must be held by a regulated professional. So therefore, it is part of that regulated service that you're providing. But overall, where the deposit isn't for a scheme and it's just agreements between landlords and tenants, then it's nothing to do with a solicitor, so you shouldn't be holding it. Okay, I've had some questions come through, so I'll just pause for a moment to answer those. So somebody asked, what is the best practical way of dealing with rent deposits if it's unlawful for a solicitor to hold them at the end of the transaction? It's a case, unfortunately, if you just need to let the client know that it's not your responsibility to hold it for them, and just assist them with coming up with a way, whether it's that they put it in a separate bank account somewhere else where they hold it and they know it's there only for deposits. Like you might have a landlord that's got lots of commercial tenants, and so they just have one savings account that holds all of the deposits. It's just advising them of things like that, but you just need to be really clear that you'll get yourselves into trouble if you do keep hold of it. And most of the time people will be understanding of that. Somebody else has asked, is that the same for monies on account taken at purchase sale if the matter proves abortive and they say they are looking for another property? This is a tough one, because obviously when they're looking for another property and it's abortive, you find that things will hopefully happen quite quickly. You just need to use your judgment a bit more on it. So if they found something within a couple of weeks or a month, then yeah, I wouldn't probably send the money back. That's fine. But if 2 or 3 months has passed and they found nothing, you'll just have to have a polite conversation with them to say, we're not allowed to hold your money anymore because of our regulations. So I'll give it back to you. And as soon as you find somewhere, we'll get started again. And as I said, people are understanding of that generally. And then somebody else asked a question. They said, according to the latest regulations, how will you differentiate between client money and office money? Please explain with an example. I presume from that you mean that not needing a client account anymore. In the terms of this particular course, I'm doing it from the perspective of the fact that you do have a client account. So generally speaking, you wouldn't be holding any client money in office, because if you have a client account in place, you should still comply with the original rules. If you don't have a client account, you can hold it in office, and it's just down to you as a firm to have good narrative in your ledger report. So like if you receive money on account and it goes into office and it was for a court fee and your bill, I would put that in the narrative. So I'd put court fee £500, bill £600, and then you know that if you raise the bill before the court fee is paid, you know what that money held there's for. But it's going to be down to you having really good bookkeeping systems with that differentiation based on the fact that you're not going to operate a client account anymore. I hope that answered your question, but if it didn't, please drop me an email afterwards and I can elaborate further. That's it for questions at the moment, so I'll continue. So I just wanted to give you a bit of best practice advice in terms of what to do about residual balances. So these are just useful tips to help you keep on top of them so that they don't get out of hand. And one really good thing that we would recommend doing is that for your file opening forms, when you sign up a new client, have on there something that asks them to write down their bank details so that you've got them on file all the time. And then that way you're in control of when the funds can be returned at the end of the matter, and you're not relying on them either banking a check or getting back to you on email or phone with what their bank details are so that you can send them money back because the matter's concluded. We'd also recommend that on a monthly basis, you provide each fee earner with a copy of their matter balances report. That way that they can annotate on it for any files that could be closed or any balances that can be returned to the client, or also if you've missed any client to office transfers for bills that could be moved over. But the important thing there is that someone in the firm then needs to take responsibility for collecting them back from the fee earners, because there's no point in asking them to do it if you're not then going to do anything with it. So for example, that might be the cashier or the practice manager, where it's someone who's best placed to action the outcomes. It also recommends that you create an internal procedures manual and policy on closure of files. That way the fee earners know what your baseline requirement is within the firm to adhere to, and you can follow up with them if they aren't complying. Because there are occasions where if we've got a firm that's got several fee earners, one partner might work with a department who works really well at getting their balances back, but they might not know what's going on so much in the other department. And then we go out and do the audit work and find loads of residual balances that the partner didn't really know about. And so then they say, oh, didn't realise that, we could have got those fee earners on with returning them. Whereas if you're doing it on a monthly basis and you've got that baseline rule in place, you've got a reason to have that conversation with the fee earner to say, you need to do this because you're getting us into trouble with the accountant and we need to rectify it. But don't forget as well, there are instances where you can still hold client funds and you will still be holding client funds, like for instance, the road adoption comments that I made earlier. And although it's not a rule to inform them every 12 months now, just be aware that the transparency rules mean that you should still keep them regularly informed. And it's down to you to decide what regularly would be. Okay, so the next slide is not a breach, it's just something that is going to become more and more of a problem for people down the line. So in November 2019, the rules were simplified considerably, and an expectation was put in place that firms would create their own internal procedures manual, and that would include how they operate the client account and how the firm should be run. Many firms just haven't done this yet, and we've recently held a webinar on how to get you started, and I've put the link in the slide, so if you do want to have a look at that, please go back and watch it, and off the back of it, if you do have any questions, please let me know. But for now, because so many firms haven't done it, when we complete our audits, we assume that one hasn't been done in any way and that the client will just continue with what the old rules were. So we audit on the old rules basically. And that's okay, but it's not going to work forever, because as more and more time passes, there'll be need for firms to create their manual, mostly because external bodies will request it. So I think there's going to be more instances of insurers wanting to see copies of it. Lexel will want copies. Your accountant, when they're doing the audit, will want it. And also when the SRA do any monitoring visits, they will probably ask for it as well. But it's not just that, it's when you bring new people into your firm, they're not going to be so familiar with the old rules, because if you take on newly qualified, for instance, they might never have even seen the old rules. So they're not going to have that baseline expectation of what they should be doing. So as I said, as time goes on, it's going to become more and more important, and you do need to start thinking about it. So next is suspense accounts. So suspense accounts are allowed as part of the rules, but only when justified. So in other words, if you receive money from an unknown source, it can be put into suspense until the client is identified, but this should be a short-term fix. We do sometimes see suspense accounts with really old balances in them, or there might be 3 different receipts in there that you just don't know who they're for. These shouldn't be held on to. So if you're unable to identify who the money relates to, then you either need to return it to the sender or send it to charity, as long as you complied with the charity rules. But the bottom line is, if you don't know who it is and it's gone on that long, you need to make a decision. Just to say as well, suspense accounts have come in various names and shapes and sizes when we've done our audits. So examples we have seen include MISC or miscellaneous, charity account, unknown, or even in a partner's own name. We are, as auditors, trained to look for all of these, so you can't hide them. We will find them one way or another, and unfortunately, if there's a lot of stuff in there, it would be something we'd have to report on the AR1. But just to add to that, well, I've just mentioned that some people call it a charity account. That's okay. I know I've just contradicted completely what I'm saying, but the rules state that when you send money to charity, you need to be able to keep a ledger list of what was sent and who it related to. So some of my clients actually create a charity account ledger and then do a matter-to-matter transfer for the balance that they plan to send to charity, so that they've got that trail, because then it complies with the rules. So that's perfect, and we're okay with that. The only important thing to remember is don't move it into the charity account and then not make a payment to charity, because then you're breaching the rules. You need to make sure that you send that payment to charity quite quickly after you've done the transfers. So I'd be suggesting that if you were having a week of looking at this, you'd do your transfers and send your payment within a week, and then you know you've complied. And the last big area for us that we do find stuff is sweeping up. This to us means where you raise an invoice to clear a ledger because you either have a really small balance or you're struggling to send the funds back to the client, you don't want to send it to charity, that kind of thing. It's really obvious when it happens, and when we see it, we know you've done it. But in reality, it's actually really difficult to prove. So sometimes we'll just say to our clients, it looks like you've done it, but I can't prove it, and you're going to tell me what I want to hear, so we'll just go with it. But all I say is, if the SRA come across it, they're not going to take kindly to it, and they will come down on you for doing it. So it's not a good idea. And also, if you do incur costs in trying to return residual balances, some people then say, well, I've incurred that cost, so therefore I can have that money. Yes, the SRA do accept it, but it's only in certain circumstances, and they provided guidance on this. So they provided guidance on the residual balances with some useful examples, which include the payments of out-of-pocket expenses. And what they've said is that the firm has no legal authority to deduct costs that they may have incurred in attempting to trace or communicate with the client. But when they grant authority for, when you send balances over £500 to them for approval, when they grant authority, they will accept if reasonable out-of-pocket expenses have occurred. And examples would be DWP fees and advertising costs. But it's important to note that if the client later reappears, the firm are liable to repay the original amount in full. Okay. The section on the rules themselves and where we find common mistakes. I'll just give you a little bit more information about some of the things that we do for you and what we can provide. So the shameless part, we're always looking to grow our solicitors department, and we like to work with more and more solicitors. And we think we're great at it, but obviously we want to prove that to you. So for our offering, we have a free 2-hour benchmarking report. I demonstrated this report in a recent webinar done with DG Legal, and you can go and have a look at that history. We will analyse your firm for you and give you an understanding of how you're doing based on that report as a offering for watching this webinar. We also do a free no obligation meeting to discuss how we can help you develop your firm and what we can do for you. And finally, we don't just do the solicitor side of the work, we also do a lot of tax work, which does work nicely with the kind of work you do. So for any conveyancing type things, we do the CGT 30-day reports. We do them in divorces and estate cases, and also for your second property sales. Sorry, that was CGT reports. The CGT 30-day return for the conveyancing transactions. We do business valuations for disputes and as expert witnesses. And we do retainer services for ongoing tax advice for you and your team. And we do assistance planning in corporate transactions and tax planning in inheritance tax and trust matters as well. So if you do have any of those occurrences and you do need any help, please feel free to let us know. And finally, these are my details. So thank you very much for taking the time to listen today. I'll have one last look to see if there's any final questions, but if not, and you want to ask me anything afterwards, those are my details. So please feel free to get in touch with me. Bear with me, check the questions. No, we're fine. That's everything covered. So thank you all very much again.
Thank you very much, Paula, for presenting and answering those questions throughout. And thank you to everyone for joining us as well. As a reminder, the slides and a recording of the webinar will be sent over tomorrow. And also this afternoon, you should receive an email asking to rate us out of 5 stars. So if you have enjoyed, please do leave us feedback. And we also welcome any suggestions for future topics as well. So our series of webinars continues on Monday, the 27th at 1 p.m, where we will be presenting a witness statement and evidence masterclass for immigration lawyers. And this will be with Sandra Akinbolu, Raphael Jezerum and Ellis Wilford from the 36 group. So that just leaves me to say thank you very much for watching and have a pleasant afternoon.
Thank you all. Bye.
Goodbye.